Class, in this lecture, we will discuss the lesson 3 of responsibility accounting, and we will discuss transfer pricing. Transfer pricing is the assigning of value or price to goods provided by the selling division as required by the buying division. So transfer pricing is important to evaluate the performance of each division and treating each division as a separate company and use its technical profitability as a performance measure. So in transfer pricing, the bulk of the problems is on determining what is or how much is the transfer price. Okay, so the transfer price is the amount charged by one segment of the organization for goods or services transferred or provided to another segment of the same organization. So managers are worried that their performance will be affected. So if they are the selling division, so they should not incur a loss if they are selling to the same unit in their organization. And if they are the buying division, they should not pay more than the price available in the market for that same goods or service. Okay, so do transfer prices matter? Do they matter? Because if you look at the organization, if segment A is selling to segment B, so in effect, it is actually parang offset, no? It is a transaction offsetting value, no? Okay, so transfer prices really matter because this affects performance evaluation of the manager, and that there are many factors that we need to consider in transfer pricing. And first is the goal congruence. In goal congruence, our transfer price should permit, no, or should allow a segment to operate as an independent entity and achieve its goals while functioning to achieve the best interest of the organization as a whole. So, meaning, the transfer prices should permit goal congruence such that one segment is attaining its goal and also attaining the whole goal of the organization. Transfer prices matter also for segmental performance, no? So, any manager should not be affected, no, or should not be punished, no, in transfer pricing. So, for example, the selling segment should not lose income by selling within the company. So, because if that happens, it is better to sell your products outside the company because that matters for the manager's performance. Likewise, for the buying segment, it should not buy the products or services at a price much higher than what is being priced or offered in the market. Because should that happen, the buying division is better to buy outside the organization and in the market because it can gain more by saving buying costs, no? Or purchase costs. So we have here the negotiated transfer price. So again, no, the point is that the buying segment should not incur greater costs by buying within the company. So if the product or the service can be purchased outside the company, the buying segment should be allowed to negotiate the transfer price, and vice versa for the selling segment. Okay? So we have here the another concern in transfer pricing, and that is capacity, no, which will be discussed later. As part of the goal congruence and segmental performance in transfer pricing, the lowest acceptable transfer price for the selling division, okay, should be the variable cost plus the total contribution margin of lost sales divided by the total number of units transferred, or this is the opportunity cost. Okay, so the transfer price should be equal to or higher than the variable cost added by the opportunity cost. Similarly, the highest transfer price the buying division is willing to pay is equal or lesser than the cost of buying from outside supplier. So if the cost of buying the product from outside supplier is 50, the transfer price should be equal to 50 or lesser. Okay, so that is the highest transfer price. So there are alternative approaches to transfer pricing. So we have the cost-based transfer price, which look at the cost basically, and the market-based transfer price if there is an existing market for the goods or services. So, so these are some of the types of cost-based transfer prices. Okay, so you have variable cost. So whatever is variable cost, then that is the price. We have the full cost, includes materials, labor, not just the variable cost, but also the allocated fixed cost. And we also have cost plus profit. So there's markup on the costs. Okay, so the only drawback for cost-based transfer prices is that the managers may need further justification for internal transfers. Like if the selling division will transfer at the costs only and there's no markup, the manager may see no point in cooperating with the transfer. So why should I transfer if there's no profit for me? No, the question, what's in it for me? No, okay. And also for the cost plus profit, if there's a target that it is the full cost, for example, plus the profit, the buying division may think of it as, well, why buy from my company if there's no difference from buying outside my local supplier or my reliable supplier? So why buy instead in a company? What's the reason? Why should I buy? There's no linkage here. There will be no discounts here. So I'd rather go to my local supplier because from time to time he is giving me discounts and so on. So those are the considerations for cost-based transfer prices. Okay, so generally, additional point is that market-based transfer prices yield optimal firm-wide profits if there is no excess capacity. So if there is excess capacity, okay, so the variable cost transfer price will yield optimal overall profits. Okay, so the goal congruent price is the price that will yield the highest profit for the company from an overall perspective. So this other authors call this as the minimum transfer price. Okay, so if there is excess capacity, now the goal congruent price is the variable cost transfer price. Like there's idle capacity, and if you'd rather use that idle capacity in providing to another segment of your operation, then that is much better. So the goal congruent price is just the variable cost transfer price. Okay, so if there is no excess capacity, then the goal congruent price is the market-based transfer price. Okay. Okay, so time for self-check number 1. Question: when a division is operating at full capacity, the transfer price to other divisions should include opportunity cost. True or false? Self-check number 2, question. When the selling division in an internal transfer has unsatisfied demand from outside customers for the product that is being transferred, then the lowest acceptable transfer price as far as the selling division is concerned is letter A, variable cost of producing a unit of product. Letter B, the full absorption cost of producing a unit of product. Letter C, the market price charged to outside customers less costs saved by transferring internally. And letter D, the amount that the purchasing division would have to pay an outside seller to acquire a similar product for its use. Okay, so let's have a sample problem. So we have here ADE Engineering Products Incorporated. Has a gauge division that manufactures and sells a standard gauge. Capacity in units, 100,000. Selling price to outside customers, 30. Variable cost per unit, 16. And fixed cost per unit, 9. The company has a pipe division that could use this gauge in one of its pipes. The pipe division is currently purchasing 10,000 gauge per year from an overseas supplier at a cost of 29 per gauge. So these are our requirements. So first assumption is that we assume that the gauge division has enough idle capacity to handle all of pipe division's needs. So what is the acceptable range of price for the transfer price between the two divisions? Question number 2. Assume that the gauge division is selling all of the gauge that it can produce to outside customers. Therefore, there is no idle capacity. So in this case, what is the acceptable range for the transfer price between the two divisions? Question number 3. Assume again that the gauge division is selling all of the gauge that it can produce to outside customers. Assume that $3 in variable expenses can be avoided on transfers within the company due to reduced selling cost. What is the acceptable range for the transfer price between the two divisions? Okay, so the first question, gauge division has idle capacity, so it does not have to give up any outside sales to take on the pipe division's business. So applying the formula for the lowest acceptable transfer price, we get transfer price should be higher or equal to the variable cost per unit plus the opportunity cost. Opportunity cost is derived by dividing total contribution margin on lost sales divided by the number of units transferred. So therefore, our transfer price should be greater than or equal to 16 plus 0 divided by 10,000, so we have 16. So therefore, our transfer price from the point of view of selling division is 16. For the pipe division, it would be unwilling to pay more than $29 the price that it is currently paying an outside supplier for its gauge. Therefore, our transfer price must fall within the range 16 or lesser than 16 or more than but not exceeding $29. So it should be from 16 to 29 only. For question number 2, the gauge division is selling all of the gauge already, so it has no idle capacity. So for gauge division to take on pipe division's business, it should incur an opportunity cost, which is the total contribution margin on its lost sales. So the same formula applies, so therefore a transfer price should be more than or equal to 16 plus we have our lost contribution margin, which is 30 minus 16. 30 is our selling price and 16 is our variable cost. Therefore, we have a 14 per unit contribution margin. Divided times 10,000, so we have our contribution margin is actually, we have 140,000 divided by 10,000 units, so we have 14, okay? Or basically just get the contribution margin multiplied by the lost sales, the sales given to pipe division, then divided by the number of units transferred. So we have 14, or basically the contribution margin. Okay, so we have 16 variable cost plus the contribution margin, so we have 30. So since pipe division can purchase gauge from an outside supplier at only 29 per unit, therefore no transfer will be made between the two divisions. It is better to purchase at outside supplier. Okay, so for the third assumption that gauge division is selling, but it can reduce $3 for the selling cost. So we have here our variable cost per unit that is reduced, so $13 plus the unit contribution margin per unit. So that's 13 plus 14 is equal to 27. So in this case, the transfer price must fall within the range 27, but not more than 29. So not lesser than 27, but not more than 29. And that is our solution. Okay, so let's have this another situation. So what if there's a difference between the number of units lost sales and the demanded units by the another division. So let's have this scenario. So just refer to the original data in situation above, no? So let's assume that the pipe division needs 20,000 special high pressure gauge per year. The gauge division's variable cost to manufacture and ship the special gauge would be 20 per unit. So to produce this special gauge, the gauge division would have to reduce its production and sales of regular gauges from 100,000 units per year to 70,000 units per year. Okay, so let's note that the units being demanded by the pipe division is only 20,000, but the lost sales or the lost opportunity would be 30,000, 100,000 less 70,000. So there's a difference, right? So this is different from the situations that we have considered in the previous slides. So required, as far as the gauge division is concerned, what is the lowest acceptable transfer price? Okay, so again, let's reiterate that to produce the 20,000 special high pressure gauge, the division would have to give up sales of 30,000 regular sales to outside customers. So when we apply the formula for the lowest acceptable transfer price, so we have here the variable cost of 20 plus the unit contribution margin, that's 14 times 30,000. Okay, so 14, that 30 minus 16, still we will use the variable cost of um, the regular, okay, not the variable cost of the special high pressure, no? Because we lost actually the regular sales opportunity. So the regular variable cost for regular, the not special high pressure gauge is only 16. So we have 14 times 30,000 divided by 20,000 units transferred. So we have 21 contribution margin to lost sales due to the transferred units to pipe division. So we have 20 plus 21. So the lowest acceptable transfer price from the viewpoint of gauge as the selling division is $41. Self-check number 3. Question. Division X makes a part that it sells to customers outside of the company. Data are as follows. Selling price to outside customers 75, variable cost per unit 50, total fixed cost 400,000, capacity in units 25,000. Division Y if the same company would like to use the part manufactured by Division X in one of its products. Division Y currently purchases a similar part made by an outside company for 70 per unit and would substitute the part made by Division X. Division Y requires 5,000 units of the part each period. Division X can already sell all of the units it can produce on the outside market. What should be the lowest acceptable transfer price from the perspective of Division X? Self-check number 4 question. Division X makes a part that it sells to customers outside of the company. Data are as follows. Selling price to outside customers 50, variable cost per unit 30, total fixed cost 400,000, and capacity in units 25,000. Division Y if the same company would like to use the part manufactured by Division X in one of its products. Division Y currently purchases a similar part made by an outside company for 49 per unit and would substitute the part made by Division X. Division Y requires 5,000 units of the part each period. Division X has ample excess capacity to handle all of Division Y's needs without any increase in fixed cost and without cutting into outside sales. According to the transfer pricing formula, what is the lower limit on the transfer price? Okay, so thank you for watching. So our next lesson coming up will be lesson 4, balanced scorecard.